Hello everyone, welcome to the 43rd episode of me learning how to trade using Forex. So in the last video we went through what is equity, we got the definition for equity, calculating equity, the account balance, what the definition for them two means are, read through all of this, made some notes, and now we're currently on what is free margin. So yeah, let's get started. What is free margin? What does free margin mean? Margin can be classified as either used or free. Used margin, which is just the aggregate of all the required margin from all the open positions, was discussed in a previous lesson. Yes, it was used margin. Free margin is the difference between equity and used margin. So, free margin. Difference between equity and used margin. Free margin refers to the equity in a trader's account that is not tied up in margin or current open positions. Difference between equity and free margin refers to the equity and the equity in a trader's account that is not tied up in margin for current open positions. That is not tied up in margin for current open positions. Free margin is also known as usable margin because it's margin that you can use. It's usable. Also known as usable margin. It's the difference between equity and used margin. Free margin can be thought as two things: the amount available to open new positions, the amount that existing positions can move against you before you receive a margin call or stop out. So, free margin is the amount available to open new positions and also the amount that existing positions can move against you before you receive a margin call or stop out. Don't worry about what a margin call and stop out are. They will be discussed later. From now, just know they're bad things, like acne breakouts. You don't want to experience them. Free margin is also known as usable margin, usable maintenance margin, available margin, and available to trade. How to calculate free margin. Here's how to calculate free margin. Free margin is equals equity minus used margin. Equity minus equity minus used margin. If you have open positions and they are currently profitable, your equity will increase, which means that you will have more free margin as well. Floating profits increase equity, which increases free margin. In your open positions, if your open positions are losing money, your equity will decrease, which means that you will also have less free margin as well. Floating losses decrease equity, which decreases free margin. Floating profits increase equity, which increases free margin. Floating loss decreases equity, which decreases free margin. Example, no open positions. Let's start with an easy example. You deposit $1,000 into your trading account. You don't have any open positions. What is your free margin? It's 1,000, isn't it? Step 1, calculate equity. If you don't have any open positions, calculating the equity is easy. Equity equals account balance plus floating profits or losses. You don't have any floating profits or losses, that is 0, so 1,000 equals 1,000. The equity will be the same as your balance. Since you don't have any open positions, you don't have any floating profits or losses. Step 2, calculate free margin. If you don't have any open positions, then the free margin is the same as the equity. Free margin equals equity minus used margin, and since you have 0 used margin, then it's the same as your equity. Since you don't have any open positions, there is no margin being used. This means that your free margin will be the same as your balance and equity. Example, open a long USD JPY position. Now let's make it a bit more complicated by entering a trade. Let's say you have an account balance of 1,000. Step 1, calculate required margin. You want to go long USD JPY and want to open one mini lot, 10,000 units position. The margin requirement is 4%. How much required margin, will you need to open the position? Since USD is a base currency, this mini lot is at $10,000, which means the position's notional value is $10,000. Required margin equals notional value times margin requirement. And the notional value of this position is 10,000, margin requirement is 4%, so the required margin is 10,000 times 0.04, which is 400. Assuming your trading account is denominated in USD, since the margin requirement is 4%, the required margin will be 400. So, required margin $400 for the open position. Step 2, calculate used margin. Aside from the trade we just entered, there aren't any other open trades open. Since we have just a single position open, the used margin will be the same as the required margin. Step 3, calculate equity. Let's assume that the prices have moved slightly in your favour and your position is now trading at break even. This means your floating profit loss is 0. Let's calculate equity. Still 1,000. Oh yeah. Calculate free margin. Now that we know the equity, we're going to calculate the free margin, which is 1,000 minus 400, because it's equity minus used margin, which is $600 of free margin. As you can see, another way to look at equity is the sum of your used and free margin. Recap. In this lesson, we learnt about the following. Free margin is the money that is not locked up due to an open position and can be used to open new positions. When free margin is at 0 or less, additional positions cannot be opened. In previous lesson, we've learnt what is margin trading, what is balance, what is unrealized, realized profit loss, what is margin, what is used margin, and what is equity. Let's move on and learn about the concept of margin level. What is margin level? What does margin level mean? The margin level is percentage value based on an amount of equity versus used margin. The margin level the percentage value based on the amounts of equity versus used margin. Margin level allows you to know how much of your funds are available for new trades. Margin level tells you how much of your funds are available for trades, for new trades. The higher the margin level, the more free margin you have available to trade. The lower the margin level, the less free margin available to trade, which could result in something very bad like a margin call or stop out, which will be discussed later. How to calculate margin level. Here's how to calculate margin level. Margin level is equal to equity divided by used margin times by 100%. Your trading platform will automatically calculate and display your margin level. Um, Equity divided by used margin. If you don't have any trades open, your margin level will be 0 because you're using zero. You've got 0 used margin, so anything divided by 0 is 0. Yeah, anything divided by 0 is 0. Yeah. So your margin level will be 0. Yeah. Margin level is very important. Forex brokers use margin levels to determine whether you can open additional positions. Different brokers set different margin level limits, and most brokers set this limit 100%. This means that when your equity is equal or less than your used margin, you will not be able to open any new positions. This means that when your equity is equal or less than your used margin, you will not be able to open any new positions. If you want to open new positions, you will have to close existing positions first. Example 1. Open a long USD JPY position with 1 mini lot. Let's say you have an account balance of $1,000. $1,000 again. Step 1. Calculate required margin. You want to go long USD JPY and want to open 1 mini lot, 10,000 units position. The margin requires 4%. Is that 4% again? $400. Yeah, 400 use margin equity. So you got 0 equity because you're floating. Profit loss is 0. This bit's new. Calculate margin level. Now that we know the equity, we can now calculate the margin level. Margin level is equal to equity divided by used margin times 100%, which is $1,000 divided by 400 times 100% equals 250%. The margin level is 250%. If the margin level is 100% or less, most trading platforms will not allow you to open new trades. If this level is reached, you can't open any more new trades. In the example, since your current margin level is 250%, which is way above 100%, you'll still be able to open new trades. Imagine the margin level as being a traffic light. As long as the margin level is above 100%, then your account has a green light so it can continue opening new trades. Recap. In this lesson we learned about the following. Margin level is the ratio between equity and used margin. It is expressed as a percentage. For example, if your equity is 5,000 and the used margin is 1,000, the margin level is 500%. In previous lessons, we learnt what is margin trading, what is balance, what is unrealized and realized profit loss, what is margin, what is used margin, what is equity, and what is free margin. Let's move on and learn about the concept of margin call level. What is a margin call? What does margin call level or margin call mean? In Forex trading, the margin call level is when the margin level has reached a specific level or threshold. So margin call. Margin call level is when the margin level has reached a specified level or threshold. When this threshold is reached, you are in danger of the possibility of having some or all of your positions forcibly closed or liquidated. Threshold is reached, you are in danger of the possibility of having some or all of your positions forcibly closed or liquidated. The margin level is a metric and the margin call level is the specific value of the metric, which is a margin level. Yeah, it's awkward, but don't blame us, we're not the ones who named these things. For example, some Forex brokers have a margin call level of 100%. In the specific example above, if the margin level in your account falls below 200% or lower, a margin call will occur. Not familiar with the concept of margin level? Read our lesson, What is Margin Level? What is a margin call? A margin call is when your broker notifies you that your margin level has fallen below the required minimum level. This notification used to be an actual phone call, but nowadays it's usually an email or a text message. Regardless of how you're actually notified, the feeling isn't great. When your broker notifies you that your margin level has fallen below the required minimum level. The minimum margin level, which is margin call level. What it feels like to receive a margin call. Your nose getting pinched by a crab. A margin call occurs when your floating losses are greater than your used margin. When your floating losses are greater than your used margin. This means that your equity is less than your used margin, since floating losses reduce your equity. Meaning your equity is less than your used margin. Margin call level versus margin call. Traders tend to get confused between a margin call level and margin call. A margin call level is a threshold set your broker that will trade a margin call. It is a specific percentage value of the margin level. For example, when the margin level is 100%. A margin call is an event. When a margin call occurs, your broker takes some sort of action. Usually the action is to send a notification. This event only occurs when the margin level falls below a certain value. This value is the margin call level. Think about boiling water. For water to normally boil, the temperature must reach 100 degrees Celsius. The margin level is equivalent to temperature. Temperature can vary and can be any number like 0 degrees, 47, 89, etc. The margin call level is equivalent to 100%, which is a specific temperature. A margin call is equivalent to water boiling, the event when the liquid changes into a vapor. Example, margin call level 100%. Let's say your Forex broker has a margin call level of 100%. This means that your trading platform will send you a warning notification if your margin level reaches 100%. Margin call level equals margin level 100%. Yep. Aside from receiving a notification, your trading will also be affected. If your account's margin level reaches 100%, you will not be able to open any new positions. You can only close existing positions. A margin call level at 100% means that your equity is equal to or lower than your used margin. This occurs because you have open positions whose floating losses continue to increase. So basically, you're losing more trades. Let's say you have a $1,000 account and you open a URUSD position. with one mini lot 10,000 units. That is a $200 required margin. Since you only have one position open, used margin will also be $200, same as the required margin. So you're currently 500% at the margin level. Oh no, 500% of margin level, if that's how you say it. Is that how you say it? At this point, you still suck at trading, so right away your trade quickly starts losing. It's losing big time. You really suck at trading. You're now down 800 pips. At $1 a pip, this means you have a floating loss of $800. This means your equity is now $200. Your margin level is now 100%. Because your used margin is $200. Yep. Beep beep. Once the margin level reaches 100%, you will not be able to open any new positions unless the market reverses back in your favour. Your equity becomes greater than your used margin. If number 1 doesn't happen, number 2 is only possible if you deposit more funds into your account, close out existing positions. The account will be unable to open any new positions until the margin level increases to a level above 100%. What happens if your sucky trade continues to go against you? If this happens, once your margin level falls further to another specific level, then the broker will be forced to close your position. The other specific level is known as a stop-out level and varies by broker. If a margin call event is equivalent to water boiling, a stop-out event is equivalent of being burned by the boiling water. Let's now discuss what a stop-out level is in further detail. So, stop out level. What is a stop out level? What does stop out level or stop out mean? The stop out level is similar to the margin call level, which was covered in the previous lesson, except that it's much worse. In Forex trading, a stop out level is when your margin level falls to a specific percentage level in which one or all of your open positions are closed automatically, liquidated by your broker. This liquidation happens because the trading account can no longer support the open position due to a lack of margin. More specifically, the stop out level is when the equity is lower than a specific percentage of your used margin. If this level is reached, your broker will automatically start closing out your trades, starting with the most unprofitable one until your margin level is back above the stop out level. Stop out level. More important, this happens this liquidation lower than a specific percentage of your used margin. If your margin level is at or below the stop out level, the broker will close any or all of your positions as quickly as possible in order to protect you from possibly incurring further losses. So, when your margin level falls to a specific percentage level, in which one or all of your open positions are automatically liquidated by your broker. Close any or all of the open positions as quickly as possible in order to protect you from possibly incurring further losses. Yep. This act of closing your positions is called a stop out. Keep in mind that a stop out is not discretionary. Once the liquidation process has started, it is usually not possible to stop it unless the process since the process is automated. Trader liquidation. Your broker's customer support team will probably not be able to help you aside from lending an ear whilst you weep loudly over the phone. The stop-out level is also known as a margin closeout value, liquidation margin, or minimum required margin. Example, stop-out level at 20%. Let's say a Forex broker has a stop-out level at 20%. This means that your trading platform will automatically close your positions if your margin level reaches 20%. Let's continue with the example from the previous lesson. What is a margin call level? You've already received a margin call when the margin level had reached 100%, but you still decide not to deposit more funds because you think the market will turn. Not only are you a sucky trader, but you're a crazy trader also. A sucky crazy trader. Anyways, your sucky crazy self ends up absolutely wrong. The market continues to fall. You're now down 160 pips. At $1 per pip, you're now floating a loss of $160. This means your equity is now $40. Your margin level is now 20%. Because margin level is equity, which is 40, divided by used margin, which is 200, times by 100%, which is 20%. Used margin cannot go below $200 because that's a required margin that was needed to open the position in the first place. So 20%. At this point, your position will be automatically closed, liquidated. When your position is closed, the used margin that was locked up will be released. It will become free margin. The end result for you will be depressing though. Your floating loss of $960 will be realized and your new balance will be $40. Since you don't have any open trades, your equity and free margin will also be $40. Here's how your account metrics will look like in your trading platform at each margin level threshold. Margin level 100%, stop out level 20%, stop out liquidation, nothing. Equity 200. Oh right, you read across that way. So margin call out level 100%. Your equity is at $200. Your used margin is 200. Free margin 0, balance is 1,000, floating profit loss is minus 800. At stop out level 20%, your equity is $40, used margin is $200, free margin is 0, balance is 1,000, floating profit loss is minus 960. At liquidation, you have no margin, your equity is $40, used margin is 0 or nothing, or just nothing. Free margin is $40, balance is $40, and your floating profit loss is nothing. If you experience a stop out and see the aftermath in your account, this is how your eyes feel. Jesus. If you had multiple positions open, the broker usually closes the least profitable position first. Each position that is closed releases used margin, which increases your margin level. But if closing this position is still not enough to get back to the margin level above 20%, your broker will continue to close positions until it does. The stop out level is meant to prevent you from losing more money than you have deposited. Oh, right, okay. Used to stop you from losing more money than you have deposited. If your trade continued to keep losing, eventually you would have no more money in your account and you would end up with a negative account balance. Brokers would prefer not to have to come knocking on your door with a baseball bat to collect the unpaid balance, so a stop out is meant to try and stop your balance from going negative. What if I have multiple positions open? The example above covered the scenario with you trading a single position, but what if you had multiple positions open? Sounds like you love gambling, so here's an example of how the liquidation process would work if you have 2 or more positions open. Each broker has its own specific liquidation process, so be sure to check with yours. But this is a popular approach and will at least give you a good idea of what kind of horror you might experience if you're trading too big. Let's pretend the stop out level is at 100%. If at any point the margin level drops below 100% of the margin required, you will experience an auto liquidation of the positions that has the largest unrealized loss. So if you have multiple positions, the open position with the greatest unrealized loss is closed first, followed by the next largest losing position, followed by the next largest losing position, and so on, until the margin level maintenance margin is back to 100% or higher. Depending on the size and the unrealized profit loss of the open position, all your open positions could be liquidated in order to meet the margin requirements. Remember, you and you alone are responsible for monitoring your accounts and making sure you are maintaining the required margin at all times to support your open positions. You've been warned. Don't be crying to your broker when your position gets auto liquidated. You can still cry, of course, but only in front of the mirror. Now that we've covered all the important metrics that you need to know in your trading platform, let's take everything you've learnt so far about margin trading and put it all together using different trading scenarios. Right, trading scenario. Margin call level 100% and no separate stop out level. Let's now take all the margin jargon you've learnt from the previous lessons and apply them by looking at trading scenarios with different margin call and stop out levels. Different retail forex traders, brokers, and the CFD providers have different margin call policies. Some only operate only with margin calls, whilst others define separate margin call and stop out levels. In this lesson, we'll go through a real-life trading scenario where you are using a broker that only operates with margin call. This broker defines its margin call level 100% and has no separate stop out level. What happens to your margin account when you're in a trade that goes terribly wrong? Let's find out. So there's a diagram. Step 1. Deposit funds into the trading accounts. Let's say you have an account balance of $1,000. This is how it will look in your trading account. Equity is 1,000, free margin is 1,000, balance is 1,000, and everything else is blank. Step 2. Calculate required margin. You want to go long Euro USD at 1.15 and want to open a 1 mini lot 10,000 units position. The required margin is 2%. How much required margin would you need to open the position? Since EUI is a base currency, this mini lot is 10,000 euros, which means the position's notional value is 10,000 euros. Since our trading account is denominated in USD, we need to convert the value of the euro to USD to determine the notional value of the trade. So 1.15 equals $1, exchange rate is that. The notional value is 11,500. Now we can calculate the required margin. Required margin equals notional value times margin requirements. So required margin is 11,500 times by 0.02, which gives you $230. Assuming your trading account is denominated in USD, since the margin requirement is 2%, the required margin will be $230. Step 3. Calculate used margin. Aside from the trade which is entered, there aren't any other trades open. Since we have just a single position open, the used margin will be the same as the required margin, so both through $230. Step 4. Calculate equity. Let's assume that the price has moved slightly in your favour and your position is now trading at break even. This means your floating profit loss is 0% or $0. Let's calculate your equity. 0 still. The equity in your account is now $1,000. Calculate free margin. Now that we know the equity, we can calculate the free margin. Free margin is equal to equity minus used margin, which is 1,000 of the equity minus $230 of the used margin, which gives you $770. The free margin is $770. Step 6. Calculate margin level. Now that we know the equity, we can now calculate the margin level. Margin level is calculated using equity divided by the used ratio times 100%. So equity is 1,000, used margin is 230 times 100%. That gives you 435%. The margin level is 435%. So all good. At this point, this is how your account metrics will look in your trading platform. Margin level 100, 400. Oh, sorry. So long, short, going long. FX pair Euro USD. Position size 10,000. Entry price 1.15, current price 1.15, margin level 435%, equity 1000, used margin 230, free margin 770, balanced 1000, floating profit loss 0. EUR USD drops 500 pips. There are reports of a zombie outbreak in Paris. EUR USD falls 500 pips, is now trading at 1.1. Let's see how your account is affected. 1.1, used margin 220, still the same. Oh no, not still the same. Free margin is 280. Floating loss is 500 because you dropped 500 pips. Your margin level is back at 227, or not back, dropped down to 227%. Used margin. You'll notice that the used margin has changed. Because the exchange rate has changed, the notional value of the position has changed. Ah, right, okay. So the original value has changed. This requires recalculating the required margin. Whenever there's a change in the price for EUR/USD, the required margin changes. With EUR/USD now trading at 1.1 instead of the 1.15, let's see how much required margin is needed to keep the position open. Since our trading account is denominated in USD, we need to convert the value of the euro to USD to determine the notional value of the trade. 1.1 euro equals 1.1 dollar equals 1 euro, so $11,000 is equal to 10,000 euros. The notional value is $11,000. Previously, the notional value was 11,500. Since the EUR/USD has fallen, this means that the euro has weakened, and since your account is dominating USD, this causes the position's notional value to decrease. Now we can calculate the required margin. Required margin equals notional value times our margin requirement, so still 11,000 times by 0.02%, which gives you $220. Notice that because the notional value has decreased, so has the required margin. Since the margin requirement is 2%, the required margin will be $220. Previously, the required margin was $230 when EUR/USD was trading at 1.15. The used margin is updated to reflect changes in the required margin for every position open. In this example, since you only have one position open, the used margin will be equal to the new required margin. Floating profit loss. EUR/USD has fallen from 1.15 to 1.1, a difference of 500 pips. Since you're trading one mini lot, a 1 pip move equals $1. This means that you have a floating loss of $500. So floating profit loss is equal to current price minus entry price times by 10,000 times by the price per pip. So current price is 1.1 minus 1.15 times by 10,000 times by $1 per pip equals minus $500. Your equity is now at 500 because equity equals balance plus floating profit loss, so 1,000 minus 500, which is $500. Your free margin is now at 280. Free margin is equal to equity minus used margin. Your equity is $500. Your used margin is 220, so your free margin is at 280. Your margin level is decreased to 227% because margin level is equal to equity divided by used margin, which is 500 divided by 220 times by 100%, which gives you 227%. Your margin level is still above 100%, so all is still well. Account metrics. This is how account metrics will look in your trading platform. Still green. Floating profit minus 100 though, minus 500. EUR/USD drops another 288 pips. EUR/USD falls another 288 pips and is now trading at 1.07120. Used margin with EURUSD now trading at 1.07120 instead of 1.1. Let's see how much required margin is needed to keep the position open. Since our trading account is denominated in USD, we need to convert the value of Euro to USD to determine the notional value of the trade. So 1.07120 dollars is equal to €1. So then you times by 10,000. So 10,000 euros is equal to $10,712. The notional value is $10,712. Now we can calculate the required margin. Required margin equals notional value times margin requirement. So notional value is 10,712 times by 0.02, which gives you 214 required margin. Notice that because the notional value has decreased, so has the required margin. Since the margin requirement is 2%, the required margin will be $214. Previously, the required margin was $220 when EURUSD was trading at 1.1. The used margin is updated to reflect changes in the required margin for every position opened. In this example, since you only have one position open, the used margin would be equal to the new required margin. Floating profit loss. The EURUSD has now fallen from 1.15 to 1.07120, a difference of 788 pips. Since you're trading one mini lot, 1 pip move equals to $1. This means that you have a floating loss of $788. Because floating profit loss is equal to current price minus entry price times by 10,000 times the price per pip. So 1.07120 minus 1.15 times by 10,000 times by $1 per pip. That gives you minus $788. Your equity now becomes 212 because equity is balance plus floating profit loss. So 1,000 minus 788, which is 212. Your free margin is now minus 2 because free margin is equal to minus equity minus used margins. Equity 212, used margin 214, free margin is minus 2. Your margin level is decreased to 99% because equity divided by used margin, which is 212 divided by 214 times by 100 is 99%. At this point, your margin level is now below the margin call level. Account metrics. This is how your account metrics will look in your trading platform. So green, green, and then red. Margin call. Your trading platform will automatically close out your trades. Two things will happen when your trade is closed. Your used margin will be released, your floating loss will be realized. Your balance will be updated to reflect the realized loss. Now that your account has no open positions and is flat, your free margin, equity and balance will be the same. There is no margin level or floating profit loss because there are no open positions. Let's see how your trading account might change from start to finish. So you started at 1,000 basically, and then you finish with 212. Before your trade, you had 1,000 in cash. Now you're left with $212. You lost 79% of your capital. Percentage gain / or loss. Ending balance minus starting balance divided by the starting balance times 100%. So 212 minus 1,000 divided by 1,000 times 100% is minus 79%. Some traders suffer a terrible side effect when finding out their trade has been automatically liquidated. Puking. Warning, a knowledge of automatic trade liquidation may result in automatic stomach liquidation. In the next lesson we can provide a different trading scenario where your broker has a separate margin call and stop out level. Let's see the difference between happens there versus what happens here. Okay, I'm going to leave this episode here. In the next video we're going to be seeing what the difference is if the broker has a margin call level and also a stop out level instead of just having a margin call level, which is what we've done this lesson. So yeah, thank you guys for watching and I will see you guys in the next video. Peace.